Guy, how are you, sir?
I'm very well, thank you, Mr. Gordon. How are you?
I'm not too bad. You're joining us on a Friday night from Australia, hopefully with something in your hand off screen. So Guy Keller joining us from Tribeca. Give us it. What's the full title?
Nuclear Energy Opportunities Fund.
Snappy. I like it.
It's a mouthful.
It's mad. Hey, well, good times for uranium and good time to be a Tribeca shareholder. That's for sure. You guys have been sitting patiently waiting for moments like this, and there's still got a long ways to go. So that's all good news. Look, you're going to share with us tonight your thoughts on what's happening in the space. Obviously, lots of geopolitical influence going on out there. We're seeing, obviously, everything that's going on is Israel and Gaza. We're obviously off the back of Russia, Ukraine, and off the back of huge energy transition moves across Europe and the US. So, what a time to be in uranium! What a time! What are your thoughts about what's going on out there?
Yeah, look, I mean, it is. There's a high risk macro environment at the moment, and an even seemingly higher risk geopolitical environment, markets across all asset classes are experiencing volatility and some upheaval and some interesting moves. I mean, it's interesting. We did come off the last quarter where obviously we didn't have some of the latest sort of travesty with Israel, but we'd come off the last quarter with still things going on. And the uranium sector managed to be a rare green shoot. I mean, we've just posted a 31% return net of fees for the quarter. So, that was a shining light for a few investors who were getting carried out in a few other things. We fast forward a few weeks into October and people are saying, I'm glad I didn't get in. It's done. I said, well, it's not done. It's just we've got a few more macro issues that are causing people to say, hang on, what are those things I've made money out of? Oh, uranium stocks, I might take some profit because I'm losing everywhere else.
Well, it's not. What's easy to understand that because you've come off the back of if you're a gold investor, 3 years of huge downward pressure on equities, risk off environment, Fed raising, we've been printing money for fun, and now we've been raising rates for fun as well. Hopefully slowed down. We've seen the last of it. You've got that. Then you've seen these, during all of that, you've seen this, huge costs and energy across the globe. Equities across the board are down. I mean, down. I was going to say sideways. It's down. It's horrific out there. People are feeling nervous. And now you've kind of got an escalation upon an already serious issue, right, with obviously Russia, Ukraine, in Israel and Gaza. And people are going from like risk off to actually nervous, slightly scared about where all this is going because there seems no end in sight at the moment. What's that going to do for equities markets? Do the fundamentals still charge on through?
Yeah, look, I mean, yes, there's a lack of confidence and there is a nervousness in all, we talk to brokers in Australia and in Europe, in North America, and volumes are down everywhere. Unless you're seeing sort of CTA or systematic or quant strategies, right? So the discretionary money is not there, and but there's things that you can't sort of ignore. As China's not as bad as things are. I mean, I did say a few months ago that I thought probably the worst thing for resources in the market would be for oil prices to rally out of all the commodities, because then the inflationary concern comes back to front and center. The cost comes to producers as well, so it makes it more difficult for them. We've sort of seen that with some pretty head scratching move in US bond prices, seeing yields going up. So there's a lot of things conspiring, but as I said, the sentiment's not there, and positioning is pretty bearish and short. So it's not. If volumes are light on the way down, they're also light on the way back up again. So, I'm sort of sitting here thinking that if we get some normalization, or at least the market decides to what they want to look through some of this short-term macro noise, and as we know with geopolitics, things can change very quickly, worse or better. you sort of can't sit there and say this is going to continue forever. And if it does turn around, markets aren't really positioned for a normalization.
Right. Okay. And I've seen you on some other shows being forced to kind of, throw out a random number about what uranium price could get to. I'm not gonna do that to you, because it's kind of pointless exercise. But what I do want to understand is, despite the kind of geopolitical pressures out there, the geopolitical uncertainty out there, there's one demand which doesn't go away: basic human rights. You need energy. You need to be able to heat your homes. You need to be able to power your car. You need to be able to power your homes, businesses, etc. That's not going away. We've seen this huge movement in political sentiment off the back of the initial reaction to Russia, Ukraine, energy costs going up. People now understand, as a baseload energy, nuclear is a nice, green, cheap solution for them. So that is still there. What, if any, of the fundamentals aren't there? Is there anything which is going to stop or cause nuclear to stumble?
Look, obviously, so when you look back on the last cycle, the GFC caused the price to normalize very quickly, or collapse actually, but it had gone from $8 to $140. And there was a big wall of supply coming to market with the Kazakhs, with Cameco, with Paladin, with a whole bunch of projects back then. But the concern then was that because the financial system globally had completely frozen, that there was just going to be zero economic growth and industry would shut down, and therefore electricity would go away. But you fast forward now, 2007, there wasn't that concern whether baseload electricity came from coal or gas or nuclear, right? Like, it was just, it's electricity. And the renewables was building momentum, but not really penetrating. You fast forward now, and you've still got that decarbonization mantra out there and policy of governments, and whilst may not be as important to them in the very short term, it's still there. So, like, I don't see very much economically that derails, because if your ultimate goal is to replace coal for baseload electricity, the 33 nations producing nuclear power have all worked out that keeping it running is the best way to do that. And, as we know, a nuclear fuel buyer is not thinking about tomorrow. They're thinking about 3 years' time, at a minimum. So it's a pretty brave nuclear fuel buyer who says, I'm going to buy less uranium now because I think there might be a global recession in 2026. Like, they're just not thinking that way. They're thinking, how much uranium do I need per year for my reactors to continue to run at the same levels that I've run for the last 30 or 40 years? And okay, I'll go and buy that. And if I, for whatever reason, produce less electricity, I've left for some uranium or fabricated fuel rods that I'll end up using anyway. So I'm just going to I'm in the cycle. I need to replace my contract. We'll go replace it. Sort of comes down to that. It looks through cycles.
Okay. Well, so we're saying, okay, so the momentum's there. The momentum is there. But there are others that are saying, and I know you've prepped a presentation for this, because the statements that are out there in the market, it's like, well, if we look at the lithium market, very quickly, the prices last October were 80,000. I mean, it was insane. And, some people would want that to continue off the back of this EV revolution we're entering. And others are going, well, okay, that's a little bit crazy. We're going to have a massive oversupply into market here, which will more than mop up any demand. Uranium, the chart is currently to look like lithium did last year. People are nervous and say we'll have the same reaction, where lithium has come off, went from 80 to 20, and I think we're sort of sitting around mid 30s at the moment, or early 30s at the moment. Will uranium fall into the same trap as lithium?
I don't know if you can see this chart here that I've got up. So the difference, the fundamental difference, as I said earlier, is that nuclear looks through cycles because it's longer term. Lithium, as I've sort of said there in a couple of those quotes on the right-hand side, it's it's consumers buying electric vehicles, which are the ultimate consumer of that lithium in the battery, right? And so if you've got energy crisis, inflation, recession, all that sort of all those fears, end of subsidies, China, the big headlines obviously there, then your gigafactories that are being built to be the future demand may have a decision here. 2/3 of European, GM delaying things in the US, and it started lithium. The lithium cycle started with the demand sort of there in China, and we remember all that Aussie spodumene was going into China, and suddenly there were the bottlenecks in conversion, and we collapsed into 2020 and before going off again. And it's we had a small deficit, and then we've had a balance to a surplus market that's going out, and we're now relying on future demand to fulfill that lithium story. So we're all sort of betting on the fact that the rest of these gigafactories will be built, and off we go, and which is why obviously the market's sort of selling off a little bit now, because of all those concerns about are there consumers to buy these things, and will that future demand be there. The uranium story, the nuclear story, we had almost a decade of primary mine supply deficit from 2011, where utilities were consuming secondary material and drawing down inventories. We've now gone into a point where decarbonization has driven those 33 countries to decide to keep reactors running that would have been turning off. We then have the Ukraine-Russian war, where energy security comes front and center, and governments are then making decisions to also keep it running, extend it, build more, and invest in new technologies. And so we've got this demand that the existing demand is now staying on, and we're not mining enough for it, and we've got all these other things going on, the other reactors being built and what have you. So the difference here is we've come through a deficit. We're in a period of demand looking more robust, and the demand's already there. We're not relying on the 61 reactors to be built to give us that deficit. We've got the deficit already. That just gives us a bigger deficit. So assuming those 440 odd reactors stay operating, we're not producing enough uranium. And so I think that's the big difference. And people who look at the price history here, we had a 1,500% odd rally. I've used spodumene prices there. But when you look down on that bottom right, and again, I've used a cross-section of ASX-listed lithium, but producer, companies building assets and developers, and I've compared it to a similar thing with uranium. Nobody was blinking when some of these things were up 10, 12,000%, because they're saying, well, that's lithium. It's a critical mineral. It's required. It's like governments are telling me this is what's going to happen. We've seen a 300% rally in uranium that doesn't look like it's topping out yet. There's no indication that it's going to top out. And we've seen 1,000+% rallies in a few of those ASX listed stocks, nowhere near the lithium, and people are saying, whoa, it's gone too far. And I say, well, hang on, last cycle we had an 1,800% price rally, and we didn't have decarbonisation, energy security driving. We had a lot of supply going on. So, when I was asked the other day where I thought the uranium price was, and maybe it was a little bit ambitious, being shy of $200, but what's to stop it? And I think that's the difference, because you can't have battery electric vehicles and decarbonise if you're plugging into coal-fired power. You need to decarbonise the electricity grid as well.
But think about it. Okay, I think the number you threw out there was one under a lot of pressure and duress, I'm sure your lawyers would argue. But the 175, right? 175 was the number. But if you look at the industry trade bodies, UXCs and et cetera,
yeah,
they are sitting this. Pricing is sub 70 in the next, right? And we're over that now, but
yeah.
Why is their caution not warranted? Why should they be factoring in other things, as you said, around demand? Why are you not just talking a good game?
Well, so the start is, the World Nuclear Association put out their demand supply forecasts that they do every 2 years. And I think one of the really, really key things here is that the WNA don't want to talk price, or they're not allowed to talk price, or they can't talk price, because they don't want to be seen to be. There you go, that report.
Report.
Yeah, so they make a whole bunch of assumptions around a supply response that doesn't talk price. And yet, even when you look at those planned and prospective mines in that supply response that only get you to the lowest demand, and in fact, can I scroll across, or is this going to ruin your presentation if I go to the this one here? So you look at that, right? The lower scenario is if things go badly, India doesn't build reactors, China slows down, the West don't really pick things up. But the reference scenario is the most likely scenario to happen. we can't even get, on the WNA numbers, we can't even get to the lower scenario demand without including the planned and prospective mines. And I'm sure you've looked at some of those that, and we're not going to get into specifics, but there's a few in there where I sort of shake my head and go, really?
I'm with you.
A lot of things are going to go right there. And I mean, even in the restart idle capacity and under development, we've had 2 or 3 examples in the last couple of months of mines that I thought were going to be into production in the near term. And they've had unanticipated, and they're supposed to be the easy ones to bring back on. So, when I sort of, 175 is a bit tongue-in-cheek, a bit controversial, and it's given them some good sound bites to go and throw out. But and that's a spot price, not a contract price. Again, I keep coming back to price is irrelevant because there's so many things that need to go right to bring any resource project to market, and there's even more things that need to go right to bring uranium project.
No, well, you make a good point, obviously, and obviously I've got to ask these seemingly silly questions occasionally, but I think there's a lot of sort of people new to this coming in at it who'll be asking some basic elementary entry questions, and you're answering them. But yeah, when I look at the nuclear, here we go, folks, the nuclear shield report. I mean, Guy, you raise a few things in there and a few eyebrows, I suspect, as well. When you're looking at some of the supply assumptions for some of these companies. Now, clearly, if they don't, that means even less supply than is currently anticipated coming to the market, which has a knock-on effect. Scarcity drives prices. So maybe 175 isn't too tongue-in-cheek, but like I say, there's a lot of things that are going to need to go right out there for supply to get anywhere near some of the estimates that's sitting on that chart of yours there. So with regards to, I mean, this part of presentation you actually did for up in Singapore. I mean, what was the answer? What were the answers that you were trying to deal with? So, what were the questions that you were trying to answer in Singapore? What were people unsure of?
The biggest they don't think that it can repeat last cycle. They're not convinced. When they sort of the big pushback I always get is, we're here at $70 odd, Kazatomprom have upgraded their guidance for 2025. Cameco's got a whole bunch of idle capacity they can turn on. Paladin's coming to market. There's just going to be a whole bunch of these things come to market, and it's dead in the water. So, analysts as well. I'm staying with a long-term uranium price of $65, and I continue to say, why? And they say, well, because that's just what's going to happen. I say, but where's it all coming from? I mean, Kazatomprom aside, I hope Cameco get to nameplate capacity on Cigar and MacArthur River because the market needs it. I hope that NextGen brings Arrow to market because the market needs it. All of those companies that have announced a restart, the market needs it. And so, this is what I continue to say to them, is that the maths does not lie. And in fact, the demand is being underestimated because China is not going to stop buying uranium basis on what they need for the next 5 or even 10 years. China's going to 52 gigawatts to 70. They want to get to 150, and eventually, there's some perspective to get to 300 gigs. That's 150 million pounds of uranium per year that country's going to require, right? And, when you put that into perspective, the US is consuming 50 odd million a year. So that's 3 times what the US is doing, which, if it was a normal cycle in commodities, as we saw in the early 2000s, where China was expanding while everybody else was contracting because, China was producing copper and aluminium and steel cheaper than everybody else and end products, so the rest of the world sort of came off, then, that competition for scarce commodity, was aggressive from China, but it was offset somewhere. The rest of the world is not stepping away from nuclear while China's trying to do this. So when you turn around and you say anything coming out of Kazatomprom, so all of that expansion in 2025, with ignoring the JV stake, so yes, Cameco will get more from Inkai and Arado will get more, and the Japanese allegiance will get more, and Uranium One will. But anything else, the Chinese are tying up and sending it straight to that bonded warehouse on the border. So it doesn't matter if they've got 5 or 6 years of inventory. They're going to continue to buy because they're going to be consuming 150 million pounds a year. And so when I continue to sort of point to the maths of the supply-demand fundamental, people get a little bit more comfortable with it. But then they say, eventually uranium's going to get too high a cost for the utilities. I say, why? They were contracting at $90, $100, $110 last cycle, and the only thing that's causing them grief is, in the US, for example, $2 gas is a problem. But governments have stepped in with production credits and what have you. If governments want to continue to produce baseload electricity that's carbon free or low carbon, then 8 or 9% of your cost being uranium for producing that, if it doubles, it's not going to move the needle.
You raised some interesting points there, and I think it kind of goes into area which I think you've talked about a few times, and we certainly talk about on our weekly energy show, which is this kind of the role of Africa in all of this. If China's going to continue to buy, and if it is aiming for 150, 300, then they need to secure supply. And obviously, they're in Namibia in a big way. They're in Niger a little bit, along with the French, and obviously the situation there is, let's say, difficult to read somewhat. Will the French be invited back in? What role does America have to play, and what will the Chinese be doing in the background? Because I'm seeing Russian companies with Russian technology, Chinese companies with Chinese technology offering SMRs up, offering export credit finance to countries. And as part of other deals. So this geopolitical component is rife, but energy is the heart of it. Energy source is the heart of it. And nuclear, these SMRs, these small nuclear, modular reactors and nuclear are part of a bargaining chip for people looking to expand their empire and their influence, sphere of influence. And, I think America seems to be getting caught on the hop on this one a little bit. But the role of Africa in terms of uranium production to feed into that, you're a big investor into Africa and other places too. But how do you see this kind of playing out in terms of bifurcation of market, in terms around pricing, access to product for the West? Because it's all well and good you saying, well, whatever is left to Western buyers, there's some there, but it'll drive the price completely through the roof. And that's one thing. Getting enough of it is another thing, right? What do you do? There is no kind of plan B or C. Renewables is just not delivering it. So again, Africa versus kind of North America, East versus West, however you want to come at it. How do you see that all playing out?
Yeah, I mean, there's so many different challenges there. And, when you look at this sort of round, whatever that is, hexagonal thingamy, whatever.
Beehive.
Beehive, that's it. There's permitting and community are very important roadblocks or challenges to overcome in North America, for example, and Australia. They're a little bit easier in Africa. The jurisdiction in Africa becomes difficult with countries like Niger, although you need to note that they've been producing uranium since 1970 through many different iterations of governance. And And then you've got that sort of high grade versus low grade argument as well. You'll be getting much higher grade hits in the Athabasca than you are in Africa. But Namibia has so far, touch wood, let's not hope we don't jinx it, but there's, again, they're big projects, low grade, fairly easy to mine, fairly easy process flow sheets, bulk moving operations. Like sometimes the CapEx can be reasonable, although some of the people there have done a good job in really defining that well. And does the country of Namibia necessarily want Chinese in every project there? Probably not. Never say never. But they've so far indicated they want some diversification. So, those, especially, as I said, Namibia now is looking even more important because of the political issues in Niger. However, I think Niger probably finds their way through it. The French maybe have difficulty in continuing to be there as they were, but I think the others there, as well as the US military presence, it's probably the last sort of toehold the US has there. So assuming they're still wanting to be in that Game of Thrones on the African continent, because to your point, Russia and China are moving a lot of chess pieces around that board. And I think when you look at what the US government's doing, with Westinghouse, with some of this, with NuScale, with Cameco even, with all of their grants and technology, they're trying to get back into the race. And they want that global presence because they realize how strategically important it is to be able to say to some of these countries, we can provide you a zero carbon baseload electricity solution that's going to be there for 60 years. So yeah, I think it's still an important strategic game or strategic place to do business for the uranium sector for sure.
But what about you? You're an investor. You run a fund, and we investors look for sort of comfort from what the big boys are doing sometimes. So is Africa still a good place to invest? Well, let's sort of even higher than that. Is uranium still a good investment, or is it kind of peaked? Which is kind of a question I asked a few questions ago. Has this still got growth potential because of what you were saying with regards to demand, because of what you're saying about the potential actually undersupply relative to what is forecast? Should we still be in the game? Are you committed to uranium for the foreseeable future?
Yes, because as I said, even with a 300% price rally, the supply issue is not being resolved, and I don't see demand going down.
Okay, there we go. The only way is up. Okay, can we look at then about some of the? Okay, so that's the theme is still strong and hot and has growth in it. Let's look at what it's doing, what's happening out there in the markets. The equities markets are difficult across the board. Uranium has, as you say, on occasion been the little green shoots of hope. That's kind of good news. But even the uranium companies are struggling to raise cheap, affordable capital to do what they want to do. So they're under pressure. We've seen a whole bunch of M&A, quite an extraordinary one recently with Consolidated Uranium and ISO Energy, our friend Craig's company, or Find, as it were, and other little bits and pieces being snaffled up here, there, and everywhere. So again, let's use your phrase, moving chesses around the chessboard without actually necessarily always making a lot of sense, but maybe it's busy looking busy without being busy being effective. So again, if we go back to the last cycle, we saw lots of new entrants into the marketplace. People got excited again. Do you think we're going to see that kind of behavior again? Lots of new unnecessary companies jumping on the bandwagon?
Oh, 100%. Yeah.
Oh, excellent. There's destroying value everywhere.
There's no doubt about it. There'll be gold companies, there'll be vanadium companies, there'll be rare earth companies, there'll be lithium wannabes who all turn up and suddenly find uranium in their deposits. No doubt about it. I mean, that's just the way the game plays. And do we get to 500 or like we had last cycle? Maybe. Do you have to take them all seriously? No, probably not.
Right. But what happened? Serious point. Investors new to this game, maybe looking in from outside, never invested in the uranium sector. When they see that happening, it says there's something good happening with uranium. But how do they behave? How do you behave when you look at these new entrants? You aren't looking to pile in, are you?
Well, no, I mean, I'm lucky. I've had a number of years where nobody wanted to talk to anybody, and Uranium basically compiling a database of last cycle projects. So, I know where there's a few pearls and gems and diamonds hiding from last cycle that, let's face it, would be much closer to development had we not had the rug pulled under us from the Fukushima Japan tsunamis. So, I mean, I look at everything.
What's the opposite? What's the opposite side of that? Diamonds and pearls and gems. What's the opposite side of that? How do you frame that in your report?
I don't know. Lumps of coal? I don't know.
Lumps of coal.
although diamonds come from coal, so go figure.
Right.
Carbon.
Okay.
But so, look, I'm looking at all of them, but I'm certainly not investing in all of them. I think, in the last 6 to 12 months, I've probably only put money in 25% of the things I've seen. And that's because I either know the team or I know the project or both. I've been certainly picky. I mean, there will be a period where there's just a pile of money just flying into everything. I mean, again, I go back to lithium. One of the reasons it's a household name is because there was so much ECM activity. Like every banker in Australia and Canada, they've all got beach houses on the back of ECM fees, bringing lithium companies no one's ever heard of to market. And that same pool of capital is just playing that insto discount, Oh, there's a raise at 15% discount. I'll sell the other things that are either flat or up. In Canada, I'll bank the warrant and move on. But as a result of that, generalists sat there and said, I've seen so many of these, so maybe I should start playing. It just becomes like the politician who's constantly telling you about whatever his message is or her message.
Yeah.
Eventually you start believing it because you hear it 400 times.
Sure, yeah, there's something in there. That's momentum, that's sentiment, and that's great, but I don't want to lose my money, right? People like
exactly
you
right.
got databases and go, I know where the gems are, and I know where the lumps of something are, and I don't want to get fooled into, just because I'm seeing a lot of stuff come across my desk or my screen, pile into everything that is being promised to me. So how do you differentiate between the good and the bad? How should I, more importantly, differentiate between the good and the bad?
Well, I mean, you're in a unique position where with your platform you're able to talk to a really broad number of people, and I think that's what it comes down to. I mean, so even if something was to come that wasn't on my database, it wasn't on my sort of radar, I do apply that beehive as well. Where is it? If it ever gets anywhere near production, what sort of money is it going to need? If they're drilling, how deep is it? What's it going to cost? Who are the management team? What support have they got in the market as to their ability to access capital? And so I go through a whole bunch of those, and then it's talking to other people. Have you ever heard about this? There's a lot of crusted on old uranium dinosaurs that have been around, plenty of cycles, who have got an opinion on everything. If you give them the time to get their opinion, obviously some of them will sit there and poo-poo things because they didn't think of it themselves. But but you're right. It's going to be, when it gets to that hype manic state, which it will at some stage, there's going to be a lot of dung piles that you need to avoid, and people will fall face first into them. But that's the same with any of these cycles. In anything, there's going to be a bunch of stuff come up that you just don't want to touch.
Something you give us the answer. Save us so much time.
Well, the answer is just give me all your money and I'll invest it for you. And if I end up with dung on my face, then just blame me.
Well, I honestly, I do think for vast swathes of the audience, the ones who said, I've seen your article, I can't be bothered reading it, can you just give me the answer? I see your video there, I don't have time to watch it, can you just tell me the answer? It's like, maybe you should be in an ETF or a fund. Because if you don't care to do any work to protect your own money, to make money, you're in the wrong game. You're in the wrong part of the arena.
Yeah.
Well, I think that's that's probably enough on that one before I get myself into trouble. Just very quickly, with regards to companies, coming back to this kind of liquidity issue for companies, it's not just liquidity and volume of trading of the stock, but liquidity in terms of access to capital to do the things that they need to do. Are more mergers, and we talk about more entrants, but are more mergers likely? Because I think it just feels like a very different market from certainly the last cycle. Last cycle has its own problems for different reasons. And you and I have been through enough of these broader market equities cycles as well. Does this feel like they've always done? Does this follow the same set of rules? And it's gone on a little bit longer, but ultimately, do we come out the other side and it's all going to be okay? Tell me it's going to be okay, Guy.
I think, look, I mean, there does need to be a lot of money spent in the sector. There's a lot of drilling that needs to be done, and there's a lot of studies that need to be updated to bring development projects closer to production. And we've had a decade of chronic underinvestment. There's no real other parallel. I mean, you could say commodities more broadly go through cycles where there's underinvestment and shareholder returns and what have you. But from sort of mature-ish industries, you've got to remember the uranium sector globally produces the uranium that is responsible for 10% of the world's electricity. I mean, it's a big burden, and something like 40% of the carbon-free electricity. And the market cap of the whole sector, including the Kazakh Free Float and Cameco, it fits inside like Woodside Petroleum or Fortescue, right? So the whole sector globally that's producing uranium fits inside a large cap resource stock here with room to swing. So it's a really, really small sector. And apart from Cameco, the big boys aren't in the sector. So, it's not like you have what your part of the world, an Angler or an Anta or a Glencore or a Teck or a Freeport with big balance sheets to spend. You've got Cameco, who are being vertical and very disciplined as to what they're doing on supply. And then you've got a whole bunch of mid and small cap companies trying to compete for a pool of capital to advance. And again, going back to lithium, the difference there was that the OEM and the gigafactory and the battery makers realized that an MOU or a contract was not worth the paper it was written on if that developer was not able to raise the money to build their mine. So you can sit there and say, I've got a piece of paper from Ford and GM saying that they're going to buy my lithium, but I've got to go and raise $1 billion and I'm a 200 million market cap company. Like, forget about it, right? And so they've progressed. You haven't seen that with the utilities. Utilities are still saying, oh, well, we want floor and ceiling and base escalated. And they're on last cycle, outdated sort of thought process. And instead of trying to protect themselves in the herd and say, well, I haven't done anything anybody else hasn't done, they need to be sitting there saying, who needs money? Who can get me those pounds in 2025 and 2026? And how much do you need? Let me cut you a check, because otherwise they're going to be short, because again, the maths doesn't lie. They're going to be short. So yeah, it's a really interesting scenario. And so to your point earlier, I think you asked about M&A. What does that do? I mean, we've seen plenty of M&A outside of uranium because the big boys are realizing they're trying to bring on a new project's impossible, so just buy existing producers. We've seen that everywhere. But again, in the uranium sector, there's no big boys doing that because they're not here yet. And so it's a bunch of smaller players saying, let's do a script deal and we'll double our market cap. And then hopefully we're more attractive to the market when we need to raise money.
But that's the problem. There are no big boys in this sector. If you combine all of the mining companies in the world, from the biggest down to the smallest into one entity, it's half the size of Apple, one technology company, right? There are no big boys. There are no one who can say, well, I've got a lot of spare cash, floating around here to walk in. So we've seen in the copper, we've seen it in lithium, we've seen it in nickel. You've kind of got industry kind of moving upstream and taking a little bit of of companies and to secure their future metals supply chain. That's great. But again, those companies themselves don't have enough money to do what the industry more broadly needs in terms of like buying this stuff. And it doesn't matter whether you're talking uranium, copper, nickel, whatever your battery needs are. It needs someone from outside the sector with a much, much bigger balance sheet, or it needs government to kind of step in, and that's always worrying when they do. Who can give you, I don't mind tax incentives, it's when they start putting money in and nationalizing things, people get a little bit nervous. But who's going to take that chance in a sector which has destroyed value for decades with impunity? And that's the problem here.
Yeah.
Is you need a white knight, who with big balance sheets, who can come in and do the sorts of things, and systematic explorations, systematic funding of development projects which actually will produce stuff, not the all too many developers who will never get stuff out of the ground, right?
And that's look, I mean, we obviously, I work for our global natural resources platform, so we're talking to all manner of producers, large and small, globally. And we often do raise this with the big boys and coal miners and things. Why wouldn't you just go and buy uranium and you can you can net off your and whether it's tongue-in-cheek conversation or whether it's a serious have you considered it conversation, the answer comes back every time. Some of them just say flat out, no, haven't looked at it, would never look at it. But there are others who have certainly looked at it, and the answer always comes back, there's nothing obvious of scale that we can buy. I mean, NextGen's the obvious exception, but you could argue that Lee will bring that into production without having to take over. So anyone thinks they need to be taken over, they're a big enough project with such phenomenal economics that anybody will finance that. So outside of that, and you sort of look and you go, oh, hang on, and you go, yeah, you're right. There's some big resources out there, but they might not have the permitting or the community or the economic study to give a copper miner or a diversified miner or a coal miner or whoever that confidence to say, while the mining technique might be the same as what I do with another commodity, it is uranium, and so I need to be 100% sure that I can rely on those numbers. And again, that's because of that decade of neglect. They're saying it's too early for us to take a risk on something like this.
It's exciting. It's exciting to be an investor. Nerve-wracking. And as a human, I'm also slightly nervous about what the hell's going on in the world. So
but I mean, the good thing about it is, as a result of that, there's not going to be a wall of supply at these prices. So, if you back yourself to be able to pick those companies that can get their head above just that rising tide of sentiment, then you'll do really, really well from an investment perspective, and you're not going to get derailed by, a mega project coming on and solving 20% of the supply problem for the world. So that is the thing that's continued to be reassuring to me is I think I've done the work to be able to say across producers, developers, and exploration, I've found a good enough mix there that I can continue to benefit from this as the market tries to get itself to where it needs to be. So there is still plenty of opportunity. In fact, more opportunities than BHP and Teck and Glencore have all come in and bought these projects, and they'll all be producing in 3 years' time. That gets a bit boring then.
Okay, end on a high. Guy, appreciate your time today. Thank you.
No problems. Been excellent. Thank you for having me. Now I'm going to go and have a Friday night beverage.